please join me in welcoming firstly Lewis and then Chris.
A quick overview of what I'm looking to go through with you today, and then go on to look at some of the big picture issues that we do think are out there in terms of the changing structure of global growth, and also whether or not financial markets, including your own industry, needs to rethink the way in which leverage is being used and will be used moving forward. We are in a recovery. The financial crisis is dissipating, the economic crisis has alleviated. Since March of this year, we've been seeing these green shoots of recovery starting to sprout, and by all intents and purposes, they do appear like they're sprouting into some form of sustained recovery. Business survey measures, which I've shown on this graph, you can see plumbed new lows. We did have the worst recession globally since the Great Depression, but we're now in an environment where for most countries these business surveys are back in expansionary territory and telling us that the economy is now recovering to some extent. The initial stages of this recovery, very simply, is driven by the fact that we had an unprecedented decline in production. It was just a year ago yesterday that we had the collapse of Lehman Brothers. We saw a significant increase in risk aversion right across the globe, and of course that really held sway amongst manufacturing producers right around the world, and we saw industrial production sink at a rate that we hadn't seen since the Second World War. And the fact that now production can rebound from that very significant lows is what is going to be driving this initial stage of recovery for the next 6 to 9 months, as we see some realignment of that production with underlying demand. The point that I would make, though, is that we need to be focused very much on the fact that, yes, production went through its worst decline since the Second World War, but so did demand. This was the worst recession in terms of final demand anywhere since the Great Depression back there in the 1930s. And we can see that when we superimpose on that industrial production line, growth in final demand amongst the main 7 industrialised economies. We had not seen anything like this before. It was far worse than what we saw with that very significant recession in the 1970s with the oil price shock. So really, if we're thinking about how sustained this recovery will be, we can't just focus on a production bounce and a change in inventory cycle. That's only going to get us so far. What we need to be focused on is what is the prospects for that blue line, and what is the prospects for final demand. And really key to that in the US still, in the short term, is the outlook for the consumer. And we've been asking a very simple question internally for quite some time, and also externally, is whether or not this is an environment where the US consumer is going to be driving a strong, sustained recovery when we have the first decline in nominal incomes since the Second World War. It's unprecedented what we're seeing in terms of the ability for consumers to grow their income on an aggregate level. Of course, we have an environment where the US labour market's improved, but they still shed over 200,000 jobs in August. And it's very likely that they'll still be continuing to shed jobs, we believe, throughout the course of this year, and the unemployment rate will still be moving higher. We do not believe this is an environment where the US consumer can be growing their spending strongly. If the US economy is going to be undertaking a sustained recovery from here, it will not be the consumer, we believe, that will drive it. We're going to have to look at different sources for that growth. We do believe, as a result, that the near-term pop-up in production will probably fade somewhat into the second half of 2010 in particular. So are we in a V? We would say no. If we are in a V, we think it's a very soft V, probably looks a bit more like a U to me, in the sense that we're going to take some time, we think, before we actually rebuild all that lost output that we saw as a result of this global financial crisis. So what about Australia? We are the envy of the industrialised world. There are very few countries that have avoided a technical recession, let alone a full-blown recession. Australia looks like it's one of those. And we can see that in terms of this chart. The blue line is Australia's annual growth in GDP, and it hasn't gone negative. We've actually stayed positive. Very sharp contrast to what we saw amongst the G7 countries. The point I want to actually emphasise to you today is that that actually isn't anything that's that new. If you look closely at that chart, this has been something that's been in train really since the last time we went into a full-blown recession in the early 1990s. And just think about what's actually happened in that 18 years, 20-year period since then. it's coincided with the emergence of China as a real significant player in the global economic landscape. And of course, Australia really benefits from that. So that sort of structural divergence between Australia and the G7, we think is something that's going to continue. We don't think it's going to fade, even if a fair amount of the increase we've seen in terms of GDP and how well we've done has been to do with government policies. We can see that very much in our labour market. Yes, we saw a big fall in employment last month. The unemployment rate, though, is unchanged at 5.8%. You can see that having gone through this period where Australia's unemployment was significantly above that of most major industrialised economies, we have for some time now been well below the main industrialised economies, and the gap there is growing rather than shrinking. Flexibility of our labour market is very important there, but also the resilience on a long-term basis of our economy is proving to be very important as well. The strength in our labour market versus other economies is helping to buttress the consumer and also the broader household spending, and will be one key reason why, even as fiscal and monetary policy is withdrawn, we won't see the sort of downturn in economic activity that we've seen elsewhere. The point, though, I'd like to make, and this is the same thing for the US and globally, is that a lot of what we've seen in terms of the resilience in final demand in the recent few months has had to do, we believe, with the unprecedented amount of fiscal and monetary stimulus that's been provided globally. We've seen that very much in the recent numbers in the US. The Cash for Clunkers scheme has seen a dramatic increase in auto sales in the United States, but we've also seen it in Australia. Retail spending in the 6 months following the first fiscal stimulus payments back there in December of last year, as you can see from the middle two bars on this chart, grew very, very strongly, particularly the green bars, which is your discretionary spending, things like your household goods, your plasma TVs. That sort of spending has grown very, very solidly. But in the 2 months since the fiscal stimulus payments have ended, so the June and July numbers that we received last week, we can see that suddenly retail spending is beginning to contract again. We're pulling back from that artificially high level of spending. And so it's really starting to play out very clearly for us that we need to be careful when we're thinking about how strong our domestic economy is how much of it was true underlying private sector demand and how much of it was temporary demand boosted by fiscal and monetary stimulus payments. And this is a really big question that is entertaining the minds of the RBA officials right now. And the minds of G20 officials more broadly. And the very key point that came out of the G20 meeting was that they're not looking to remove that stimulus anytime soon. We think that that's broadly a similar story that we should be seeing in Australia. We think the stimulus is still required. We don't think that the private sector is sufficiently healed. They need that support there to allow them to continue to recover in a much more benign fashion and do the deleveraging process that they need to undertake. The one thing, as I mentioned before, that is supporting Australia is this long-term structural emergence of the Chinese economy. The blue line up until the July numbers shows you what industrial production for steel, which is a big driver of Australia's growth performance because of their iron ore demand that comes from that. We can see that it's grown relatively solidly, a big rebound from where we'd seen in the period after the collapse of Lehman Brothers. What we would say is that people are underestimating just how much the Chinese economy is actually growing at the moment. And so when we extend that blue line and we just assume that industrial production grows at the same rate it has done in the first 7 months of this year, you actually see the orange line where steel production suddenly accelerates on a year-on-year basis to about 50%. Simply an unsustained growth rate in spending driven by their very massive fiscal stimulus package. And so when there's been a lot of volatility in the Chinese equity market of late, concerns about Chinese authorities removing stimulus, we say fantastic. You should be looking to take some of that stimulus off the table, particularly the stimulus that's just flowing through into the share market, that hot money, that speculative money. What we want to see is just money that goes through in terms of the real economy, in terms of boosting the infrastructure of the Chinese economy rather than flowing through to the asset markets directly. And we do need to see this growth rate of steel production start to come back a bit. We're not too concerned about the prospect of a slowdown in China because the reality is it's growing much quicker than what people suspect. This is an economy we think that is going to really help Australia over the next little while as well. And that leads me to sort of think about some of the medium-term issues, and I continue to believe, as I did last year, that emerging economies are proving to be the new engines for global growth. Last year was this whole concept of decoupling, of course, got a very dirty word. People associated with decoupling with the notion that China wouldn't slow if the US went into its worst recession since the Second World War. Well, that's rubbish. Of course China's economy is going to slow if that happens. Okay, they're not completely disengaged from the rest of the world. For me, decoupling is the notion that you will see a continued growth divergence between those two economies, between the growth prospects of emerging markets more generally and the G7. And that's exactly what has continued to play out throughout this year. And of course, stimulus has helped that. And it's really part of a broader trend. You know, the industrialised economies have already reached that level. The emerging economies are playing catch up in terms of their productivity, their infrastructure investment. They are moving up the industrialised sphere, and as a result, they are the ones who are driving global growth, and they are increasing very quickly as a share of global GDP. Look back at 2000, the blue bar, US, there, the first bar there, they were more than 30% of the world economy. They actually grew pretty strongly through to the period of 2008. They actually grew around about their long-run trend rate, yet they still shrunk as a share of world GDP. Of course, Japan in dire straits, not really growing that quickly at all. We saw them shrink very dramatically as well. Who made up that gap? It was the emerging economies, particularly those BRICS economies, Brazil, Russia, India, and China in particular. We can see they're growing very strongly as a share of world GDP. In fact, if we just assume that in the next decade they grow at roughly the same pace that they grew over the last 10 years, and assume the US and all the other countries do the same, then by 2020, those four economies alone will easily surpass the US and Japan combined as a share of world GDP. And there's actually a chance that China by itself could actually emerge as being the single largest economy in the world. These are the economies that we need to be focused on when we're really thinking about the global growth drivers. What drives that? Well, it's a simple process of urbanisation as a process of industrialisation in China. It's nothing new. Every economy around the world that's industrialised has gone through this process. The difference, of course, is that they don't have 1.6 billion people. China does. So when they urbanise, it means this sort of infrastructure investment that they require over the next sort of decade to 2 decades. They need to build the equivalent of the entire US housing stock. To put it more local flavour to that, every 16 months they build Australia's entire housing stock. I quite like the 5 billion square metres of paved road. Chris might correct me on this, but I'm led to believe that that's more than the entire amount of paved road in all of the United States. That's new road that they need to build over the next 17 years. You know, the question, of course, is whether they can do that. Big question. Are they going to try? Yes, they will. That's a lot of commodity demand, and we think as a result of that, a lot of demand for Australia's goods. Another reason why that continued growth divergence between Australia and the rest of the world, we believe, will be sustained, even if it is a period over the coming 6 to 12 months where growth will be subdued as fiscal stimulus starts to fade. The great thing is my old bosses at the RBA, particularly my old boss Glenn Stevens, the current governor, seems to agree with this view as this quote from his February statement plays out. He does believe that China has a long run to go and will continue to provide support to Australia. I think the other big issues that are very much front and centre now, probably more front and centre than the changing mix of growth between countries, is this whole notion of deleveraging, and I think the changing mix of industrial economies growth. Deleveraging is for us an ongoing process. Here we're looking at the US personal saving rate. You can see this long run structural decline. It coincided with a significant run of asset price increases, boosting household wealth higher and higher and higher each year. Of course, if your wealth is increasing, you don't need to save as much out of your current income to be able to afford the sort of retirement that you want to live. Of course, we're now in an environment where we've had significant wealth destruction. People need to save a lot more. They need to start to put some more money out of their back pockets each week in order to sort of hit the sort of retirements that they want to get. At 4%, we think the saving rate probably has further to run up from here, and that's going to constrain the US consumer moving forward. The big point is the extent to which the public sector has effectively just replaced private debt for the moment. Everyone's concerned about Australia's public deficit, and what I've done is on this chart I've compared Australia's government deficit with that of the US and the United Kingdom. You can see just how bad the US and the United Kingdom's deficit is in compared to Australia in terms of their their net debt as a share of GDP. At some point they have to address this, and when they do, who's the one who bears the burden of that? Well, you either face increased taxes or lower government spending, in which case you need to start to pay for your health benefits or whatever it is yourself more. So ultimately it's the consumer. So when the global governments of the world, the sovereigns of the world finally address this issue, and they have to, otherwise we're going to have some problems with the sovereign debt space, then you're going to see this renewed pressure on the consumer moving forward. This is a real big policy risk. They remove this too soon though, there's your double dip, your W-shaped recovery, where you get another renewed recession as the support for the final demand diminishes as the public sector withdraws. So this is a big issue we think that's going to constrain growth over the medium term as governments address this. The broader point we think is that we need to assess how leverage is being used. Leverage in of itself isn't a bad thing, but what's increasingly become clear is the very significant and profound point made by John Maynard Keynes in response to the depression back there in the 1930s. And Keynes made this very simple point. He said in his general theory that when you leave the capital allocation of economy in the hands of a casino, that allocation will prove to be ill done. Guess what's happened? The casino is the one that has driven the capital allocation of the main industrialised economies in the last 5 or 6 years. What I've done on this chart is I've gone back a little bit further. We've looked at global leverage buyout activity. They're the bars on this chart. And I've compared it to the US S&P earnings per share. And you'll have a look that what tends to happen is when leverage buyout activity occurs, you see this massive spike in earnings per share. It's not because earnings are rising, it's because we're reducing the number of shares that are out there. It's artificial, okay? And so of course when leverage buyout activity diminishes, guess what happens? Earnings per share retrenches very sharply. We go below the zero mark on that right-hand scale. Of course, the other time when it didn't happen was the mid-1990s. That was when we actually had genuine boosts in earnings. When it came down, it didn't actually fall below the zero line. That's what we want to see. We want to see investment to build capacity to generate sustained earnings, not leverage to buy a company and take their shares off the market. Now let's superimpose on that chart what happened in the previous 5 years. Same chart, the last 5 years superimposed. The extent of leverage buyout activity was unprecedented. Now, don't get me wrong, not all leverage buyout activity is bad, okay? But when it happens to this extent, it's no surprise that we saw that significant boom in earnings per share, and as leverage buyout activity has diminished, as credit has become constrained, it's no surprise that we've seen over the previous 12 months such a dramatic fall in earnings per share. So we need to rethink the way in which the casino is allocating capital, or better yet, we need to make sure the casino isn't the ones that allocate the capital. And it really comes down again to this point I made before about will the US consumer drive this recovery? Well, we can see on this chart the US consumer, which is the brownish line on the chart on the left-hand scale, they're currently around about 71% of the US economy. Really, can they keep growing as a share of the US? We believe no. At the most, what they can do is keep that share where it is, and I think more likely they need to probably pare that back. What's really clear when we look at this chart is the blue line. Let's look at equipment investment. This is the traditional way at which the superannuation industry in particular, and we talked about in the last session I overheard, the way in which it's kind of tried to generate wealth. You know, you pool some assets together, you go and invest in expanding capacity, and you generate earnings and wealth as a result of that. Well, in the United States economy in recent times, equipment investment, once you exclude that high-tech investment, which has a lot of replacement value, you have to replace it and churn it very quickly, we have never seen it so low. It's about 2.5% of the US economy at the moment. And as a result of that, the US industrial capacity at the moment is shrinking for only the second time since the Second World War. If the US economy is going to grow moving forward, they can't keep sustaining this. They need to start allocating investment away from just boosting asset prices to actually the traditional model of growing their economy, worthwhile investment opportunities. And we would say that when it comes to one area in particular they need to address, which is infrastructure, there are plenty of opportunities here for the US economy to revitalise itself, and we believe this is the way in which the US economy needs to move forward from here. This chart's just a simple visual representation of one component of that, which is the infrastructure when it comes to the road networks. Remember that most of the US national highway system was built as a result of the New Deal, which got the US economy out of the Great Depression. The problem with that, of course, is that US bridges are designed with a 40 to 50 year time frame. More than half of them are reaching that age now. And as a result of that, you can see there are only a few states, there's only 6 states, where the number of bridges actually are fulfilling the needs and what they were supposed to be designed for. They're either structurally sufficient or they're not obsolete anymore. But look at the sea of red there, particularly in that northeast component where there's a high population density. These significant number of bridges in their national highway system that are either structurally deficient and at risk of collapsing or just no longer fulfill the purpose that they're doing. They're roadblocks constraining the US economy. The US economy needs to invest in this area to unleash those roadblocks, improve efficiency and move forward. And if you want to think about some other broader structural issues like the US current account, at the moment, more than half of the US trade deficit is in one commodity, oil. If you can reduce your inefficiencies in the US transportation system in other areas, then you can reduce the demand for oil and you can, as a result, reduce the US current account problem as well. Let's sum this up into a quick market outlook. We do believe the cost of credit is not going to go back to where it was in the sort of period where the casino was ruling all. We think that people will have trouble getting access to credit. The ones who just want to use it for speculative investments or have used it for speculative investments in the past, they're going to find their access to credit quite constrained. And as a result of that, the key point I want to make to you today is that the gap between the winners and losers moving forward is going to be greater than what it has been. We don't think this is an environment for index investing. We think you want to try and beat the index. And as a result of that, we really think this is not just the year of the credit or the equity analysts, we think it's the cycle of the equity and credit analysts, because we really do profoundly believe that the gap between good and bad will be much greater. And not only do you want to be in the good, but you want to avoid the bad as well. I think the changing structure of global economy has very significant implications as well. There's no question the US consumer needs to repair their balance sheets. That's going to have implications for growth moving forward. Elsewhere, those people who are built on the US consumer will struggle. Those who are more tied in, we think, to the investment side should do better. So just a quick summary then. We are in a situation where global growth is recovering. We do think, though, that we're in for some potential disappointment relative to what is priced into markets. They do have a very solid V priced in. We think there's a chance it could be more of a U. And if policy is removed too quickly, we think there's a chance of a W as well. We like Australia. We think we continue to perform well, but as policy stimulus is removed, we don't think we're going to be shooting the lights out either. And I like the China story and the impact it's going to have on Australia. Moving forward, the big picture issues, I think, is the changing structure of global growth. Superannuation industry, as it has been doing the last few years, needs to keep that very much in its mind. And I think the deleveraging process and the way in which the markets allocate leverage and credit is very much going to be fundamental to the economy moving forward, and also to where superannuation returns will be driven as well over the next few years.
Well, Lewis did a phenomenal job of walking through the macro picture, and I can't disagree with him on all the challenges that the U.S. Faces. But as an investor, what do you do about it? And where are we within all these cycles, and what are the implications for the various asset classes? And so I'm going to approach the discussion of where we are as an investor, as someone who has to move a few $1 billion around and try to earn a return for clients that have to meet their liabilities and obligations. And it's a challenging environment to do that. And I don't think the industry is well prepared. And I don't think a lot of my peers are well prepared. And we'll talk a little bit about why. So where are we right now? Well, what do we know? We know governments saved the day. They strolled in. They put their balance sheet in place, or the private sector balance sheet. And that stopped the decline in asset prices. And that stopped the overall deflation. And that's allowed credit markets to reopen, and that's huge, and that's what the rally reflects. There were plenty of companies we looked at that were going to be bankrupt. They weren't going to be able to refinance some securitizations, and that was going to be a terminal event for them, and those valuations have recovered. We know that the economic cycle shows signs of stabilization, but we also know this cycle is very different. There's no question about it. Very low probability that the consumer is going to lead us out. Very low probability that I think we can even have significant positive nominal GDP growth once we start removing the stimulus. But what do we don't know? We really don't know what the sustainability of the recovery is. Everybody likes to look at the stimulus as a positive. I'm not convinced it is. I can tell you there's a lot of people in the States that are holding back on investments, that are holding back on business activities because they don't know how high their tax rate's going to go. They don't know how low their dollar's going to go. So they don't know what those cost of living adjustments are going to be. How do you calculate the discount rate for a new project if you can't ascertain the range of possibilities for either one of those two elements of your valuation? It's tough. So we've got to bring resolution to these issues before we can really move forward and talk about the nature of the recovery. And then the question I have, which is, okay, we've ended the crisis within the private sector for the credit market. There's no doubt about that, and I'll show you kind of a checklist we built a couple of years ago to go through. But all we did was move it to the public sector. The U.S. is bankrupt. There's no question about that. The government can't possibly pay off their debt, meet their social obligations, and continue to fund their deficits. So the question is, how do we default? There's a long history of governments defaulting on their debt. And the US has this issue, the UK has this issue, Japan has this issue, and the Eurozone has this issue. And they're going to have to go through and renegotiate these obligations both with their citizens, both with investors, both domestic and foreign investors. And the way that plays out is going to have profound implications for individual investments. Less so for asset classes, and I'll get into a discussion as to why I think that's the case. Because the real issue is, are we going to continue to undergo quantitative easing to fund the deficits? Or are we going to resort back to fiscal discipline? I think they've already decided they're going to use quantitative easing. We know that. They can't bear the thought of another debt deflation spiral. So they're going to try to reflate. Can they? I don't know. We've got to wait and see. $5 trillion has to be raised over the next 12 months to fund the global budget deficits. It's a lot of money. The U.S. savings rate clearly is going to 10%. Maybe that raises another incremental $800 billion to $1 trillion. The U.S. has to fund $3 trillion, so that's a third of it, so we can internalize a lot of it while the rest of the world funds their own domestic deficits. But is it going to be enough? Yeah, perhaps for 1 year. But what about when we roll through to 2010 and 2011? We don't know. We got to wait and see. So where are we in the credit crisis? This was a checklist we put together 2 years ago that said, okay, the securitization market's going to shut down, the banks are going to be nationalized. So how do we know when it comes to an end, when we can start thinking more about being offensive in our investments and capital allocations decisions rather than defensive? So we said, what do we expect to happen? Aggressive Fed easing, fiscal stimulus, non-conventional policy action, all the typical stuff. But what do we really need to have happen? Transparency of losses in the financial system. We have to be able to put our arms around how big they are. We can do that in the U.S., right? We have enough transparency. We can estimate what's left in the commercial real estate cycle. We know what the refinancing cycle looks like through now in 2014, and it is ugly. It is really ugly between now and then. Thank goodness the credit markets reopened because it's taken a little bit of pressure off. We know we needed to raise $1 trillion just to deleverage the mortgage market. Well, clearly we need to raise more than that, and we're well on our way. So we feel good about that. So we can check off most of the things on our list. What's really surprised us, though, is we expected the unlevered buying of credit. We expected when the credit markets healed, we would get assets to a level and yields high enough that people would go in and not use leverage again, and they would just start buying credit. Man, were we wrong. These credit funds right now are buying credit hand over fist, the yields are too low, and they're leveraging it up again. The credit markets are infinitely stronger than the equity markets right now. Equity markets have a long way to go to catch up with what credit's done in the last few months. So these are just a few charts we track. Investment grades normalized, high yields normalized, the TED spreads come back in, leveraged loans are starting to recover in value. But where are we? Can governments leverage up to offset private market credit contraction? I don't think we'll know for 2 or 3 quarters. Will the economic recovery be sustainable? Look, we've got a great inventory cycle right now. If your industrial production's down 15 to 20%, but you slash cost and inventories 30%, there's nothing on the shelves anywhere, period. We're going to make a lot of stuff for a couple of quarters. Analyst estimates are too low for this quarter we're in now. They're going to be too low for the fourth quarter. Are they too low for the first quarter? I don't know. We'll have to wait and see. We'll have to see if we get any unintended consequences. Where are we in the economic cycle? Lewis already covered a lot of this, so I'll try not to repeat too much of it. same issue, sustainability of the recovery. All the leading indicators we look at for the bottom of a recession are in place. Is it real? Is it driven just by stimulus, or is there more to it than that? So ratio of coincident to lagging indicators, anytime it's ticked up twice or 2 consecutive months, it's bottomed, ticked every recession within 2 months for the last 60 or so years. It's ticked up. It looks good. Leading economic indicators, they look good. Is it real? Is it just stimulus? We'll have to wait and see. We've had the spike in unemployment claims, and it's turned back down. That's great. But just laying off fewer people isn't going to solve our problem. We have to see employment stabilize. The unemployment rate's going to be ticking up easily for another couple of quarters, if not much longer. But we still have to just stabilize the current level of employment. And more importantly, we need to stabilize incomes. Incomes can't come from government subsidies. And again, this is just highlights that we're seeing a fairly significant inventory cycle. So where are we in the capital market cycle? Why would somebody be interested in equities right now? It's simple. Your measurement unit that you've used is under attack. What's a dollar worth? What's a euro worth? What's a yen worth? The governments are telling you they're going to be worth a lot less. All a risky asset is, an equity, a commodity, a fixed income security, it's just a temporary store of wealth. That's it. Currencies are too. Currencies are a really bad temporary store of wealth right now. So this would tell you, hey, maybe equities are worth looking at. Secular trends. This is the real question right now. Where are we in this trade-off? You go through 30 or 40-year cycles where you trade off between paper assets and hard assets. So this looks like real returns. So when the line's going down, the S&P is underperforming the commodity cycle. 2000 commodities bottomed. They ran up through mid-08. We fully corrected the initial move in what I believe is the very early stages of a bull market. If you see a 50% decline in a risk asset class, it's either the greatest buying opportunity in your life or the fundamentals underneath it have shifted. And the fundamentals under equities have shifted. And they shifted because we were pushing on a string. We're not getting any incremental return out of the leverage. We're boosting asset prices, as Lewis said, by M&A activity, not real economic growth. So just like in 82, though, when equities bottomed, they ran to 87, they declined, you bought that dip. It was very early in a bull market. Commodities, I would argue, in the same situation. It was very early. Here's the commodity cycle for the last 200 years. All these cycles look the same. What people got to realize, the last 25 years are the anomaly. They're not the norm. And so when you look at these cycles, there's things you can do. I understand if fossil fuels move, what that means for ag, what that means for other industrial commodities. It's a given. It's just physics. It's just economics. It has to happen. And this is why it does, right? You have to have the price signal. We've underinvested in the energy industry for 2 or 3 decades. You bring a few billion people into the developed world, they want to drive cars, they want to improve their diet. It's all energy intensive. There's way too many guys in the world that do what I do, especially in Houston, Texas, the energy center, right? We need more geologists. We need more infrastructure. My son's 14. When he graduates, he probably isn't even going to be thinking about finance or business. I hope not. He needs real skills. So you get a price signal, you start making an investment, but you have to tease a whole new generation into that industry. And that's the problem with this cycle, right? Because the credit cycle, just like it did in the 1930s, interrupted a major commodity investment. It shut it down, which means there's a lot of investment that needs to be made and that financing got deferred. So even in this correction, this is the same chart looking at the real returns of the S&P versus commodities. Commodities are still outperforming. The trend hadn't changed. Doesn't mean it's going to continue. And then this is a rolling look at who wins out in kind of the supply chain, your factors of production, labor, land, capital, equity or debt. It's a rolling cycle. So where are we? Oh. I would argue we're still in the previous step, that we're still going to be rewarding commodities. So why is the rally right now significant? Right? You go from disbelief to belief to despair. That's the cycle. And the important thing about a secular bear market is you have to take everybody out and shoot them. The buy and hold guy has to lose all his purchasing power, right? The momentum guy has to buy every chart at the top and lose it at the bottom, and the market timer ultimately gets his face ripped off simply because the rallies get sharper and they get shorter. And so whatever technical whiz-bang system he's using doesn't work. Their euro-yen cross rate was a great way to tell whether people were leveraging up. It stopped working in the last 4 weeks. A lot of people got short because it was breaking down, so they assumed the markets were going to sell off. I bet people lost money. So what's going to happen? We go from disbelief. Is this the next stage of the bull market? So we're in the disbelief stage? Or are we going to go into a W and recognize it's despair? If you look at the typical bottoms in market cycles, you can look at the replacement value of your asset base to the market value. You know, the ratio can vary. It averages about 0.3. When we got down to the lows in March, we were at, I believe we were at 0.38, 0.39. Very close. Very, very close. So do we need to go to new lows? Not necessarily. Let's hope we don't. Because if we go to new lows, it means we weren't successful in engineering inflation, that we ended up in a deflationary environment. But can we retest lows? Sure. Will it be very different than it was before? Absolutely. Because the last time we sold everything, diversification didn't matter. It'll matter this time. Because whereas before, the rate your security sold off was generally tied to who held it, how many times they levered it. And certainly in the small cap space where I've spent a lot of time, there's business models that didn't need to exist and were going to go away. But the sell-off is going to be different this time. So is the Fed pushing on a string? You're getting to the zero bound line. You add another $1 a debt or $4 a debt, you don't get any GDP growth for it. So consumer debt shrank by $20 billion. If the aggregate debt base, and we're going to have to deleverage, we all know that. If we've been growing based on debt expansion and debt's going to be flat to contracting, can we really generate nominal GDP growth? No, certain sectors can. Certain sectors are going to do phenomenal. And this gets back to why you don't want to index. Why is this industry not prepared? They forgot how to allocate capital, right? In a secular bull market, every asset class does well. It doesn't matter what you own. You get all these technical quantitative investment strategies. You use leverage looking for the incremental rate of change in the movement up. You have way too much diversification. Everybody's a long-term investor, but they trade, right? They're trying to decide is small better than mid or large. That works in a secular bull market. Every cycle we've been in since the early 80s, you took interest rates down, you boosted asset prices, you stimulated primary demand for consumer durables, and the consumer levered up their balance sheet because the cost of financing was cheaper, and incrementally he could spend more because his asset values were boosted. The path of rates is very important. We're at zero. You're not going to stimulate any more asset inflation when you're at zero, so that trend's going to change. The investment opportunities are incredibly fleeting. All the guys that are making allocations today, pouring money into credit, missed it. Credit was cheap till about May or June. These guys are buying because they have to. They got fund flows. They want to stay in business. They're a hammer. Everything looks like a nail. Buy it. It really may be different this time, right? It is. We know it is. We just haven't got to the despair phase to admit it yet, which is okay. We'll get there. And then you can make a lot of money. You really got to recognize the temporary storage capacity of a risky asset. That's why liquidity is so important. And the interesting thing, when you get into a secular bear market, the psychology gets pretty perverse. Everybody becomes long-term when you need to trade. I can't tell you how many clients whined to me in the last 12 months, well, your turnover's gone up. Yeah? Have you seen a currency chart lately? Have you seen what happened to leverage? You have to trade. You have to. Because I saw a stock I wanted to own, phenomenal business, completely leveraged to agriculture. This company was a $400 million company when we bought it. When we started looking at it, it was about a $1.3 billion company, maybe more than that, $1.4 billion. Between there and one other competitor, they control 80% of the irrigation in the world. That is a great business. That is a core holding for 10 years. I wanted to pay 26. It was trading at 130. It got to 26. I bought 7% of the company. 8 weeks later, it's at 45. Take your profits. It'll come back. You got to take advantage of what the market gives you. And then how do you allocate capital in quantitative easing? Why is gold going up, oil going up, equities going up, credit improving? Because they're telling you the currencies aren't going to be worth the paper they're written on. There's a huge history for this. It has always been the case. These are 80 to 100-year cycles. These aren't new. This is something we put together. It's similar to the hierarchy of needs for the human condition: food, shelter, all that other stuff. You need your parents to love you. What we said was, there's actually a hierarchy for a functioning credit market, and this is why the industry wasn't ready for what happened. The very bottom part of that pyramid, an expanding monetary base. When the shadow banking system blew up, that was gone. And then we destroyed the functioning of the credit markets. And without those two elements, you have no risk appetite. Period, end of story. And without a risk appetite, you don't have business activity, you don't have spending, you don't have planning, you don't have anything. So worrying about secular trends or cyclical forces or company strategy or valuation is irrelevant. But that's where we are today, because the industry always assumed those were in place. They're just now coming to grips with the fact that, I don't know, is the monetary base going to be expanding or not? We added $800 billion of excess reserves to the Fed balance sheet. We haven't grown another dime since December. Is it any wonder that we've had a rally? Pump $1 trillion in, something's got to move. There's no question about it. And these technical factors, all these leverage strategies, guys that quantitatively screen to buy the bottom decile of something. Okay, that's good, but when it blew up, they had no idea what their businesses did. You got to be a capital allocator. So what is the implication for investors? Valuations relative to fundamentals are key. That's always true. It's investing. It's not statistics. Don't ask yourself, are smalls cheaper than mids? They usually do well in an economic recovery. That's not the right question. The right question is, what investor out there has a process that captures value? Because there's opportunity in every asset class, and there always will be, while no asset class is going to do extraordinarily better than another. That's what a secular bear market does. So you have to be able to take advantage of it. The problem this industry has is it's way too diversified in each asset class. Way too diversified. When the entire world is printing money, it has to go one or two places, either into consumer prices or risk assets. When your supply curve is completely horizontal and you have more than enough labor, more than enough capacity, and very little to no in demand, if not shrinking in demand, it is not going to go into consumer prices. It may go into the intermediary goods prices. There's no doubt about that. So when you ask yourself, is there going to be inflation or deflation, the answer is yes, both. So what do you do in your business if you have both? You better have a damn good business. You better be able to have pricing power. So you need high ROAs. And so the way that we look at it is, if dollars are being printed and they're not going to go predominantly into consumer prices, they're going to go into risk assets, where are they going to go? They're going to go into unencumbered assets. What's an unencumbered asset? The most unencumbered asset on earth is gold. So throughout the crisis, all the dollars that were printed, it went to gold. The dollar rallies, gold is strong. It stays absolutely flat in dollar terms and moves up in euro and Swiss franc terms. It is still strong. People start getting confidence, credit markets open up. So you can start asking yourself, what businesses out there don't need to access the credit market? Whose businesses in markets weren't impacted by the availability of easy credit? You start asking those questions. Who is still raising prices today, even though they're operating at 60% utilization levels? And what are they doing with that cash? And they're giving it back to me. They are increasing their dividend. Company Jarden announced the dividend for the first time. They should. They make baseball gloves and baseballs. Nobody took out a home equity line of credit to buy another catcher's mitt. That business is not broken. They dominate it. high returns. It's going to beat cash. It's going to beat sovereign yields. They're going to extract value. And it doesn't matter in 5 or 10 years whether we're trading seashells or US dollars. They're going to get their share of them if a kid wants to get up in the morning and play baseball. That's why equities can do well in this environment. You need low capital intensity. You need capital discipline. And yes, turnover is going to be elevated. There's no doubt about it. And separate the investable world between what is oversold and what is undervalued. Because if they can't reinvest, they can't protect their margins, or their end markets are shrinking, at best, they're oversold. A lot of the apparel stores in the US got oversold. We bought them. They're not undervalued. Abercrombie & Fitch is not going to be growing their store base. They're going to be shrinking it. It's mathematically impossible for your intrinsic value to go up if your balance sheet is shrinking. There's a few extraordinary circumstances where that's not the case. But realistically, it's not a good situation. Indices are going to continue to struggle. And I'm operating under the assumption that the next crisis is going to be in the currencies. How, when, where, I don't know. The US is in a tough spot, no question about it. We're the least levered of the industrialized world. Japan's increased their debt to their GDP from 90 to 170%. They spend 18% of their government budget on interest at 1% and change. Their national pension plan told the government this year, we're a net seller of debt because of the demographic issue. They have to go externally to raise debt. Who's going to lend Japan money at 1.2%? Not me. They pay 3 at 60 or 70% of the budget. Quickly snowballs to where it's 80 to 100% of their budget. You think they're going to continue to do quantitative easing? I do. So where is it going to play out? What's that going to look like? What do you do as an investor? Know your companies, know the implications, know who has currency differentials between their cost base and their revenue base, and just be ready. Just learn to deal with it. That's it.